Welcome to the Traders Workshop. This is the second video in this 4-part series, and whether you're just getting started in the market or you've been at it for years, or you're looking for a new approach, this is the place to be. This is a series to help you build your trading plan from the ground up. I'm Jason McIntosh, and I've been trading markets for more than 30 years, and since 2000, I've also been helping traders develop their strategies and helping them identify some of the most exciting stocks on the ASX. During this time, I've helped thousands of people approach the market in a better way. People maybe just like you. I've taught them how they could maximize their profits and minimize their losses, all by following a straightforward process. A process you could make your very own. Now, this workshop, I'll be teaching you the core of my trading strategy. If you're not familiar with me or my approach, I'm the creator of Motion Trader, an algorithmic trading system for trading ASX stocks. My approach is, look, it's essentially a formula, a proven, time-tested playbook used by some of the world's best traders. Now, if you're just getting started, this is how to begin on the right path. And if you've been searching for a better way, this is what you could do to get on track. Even if you're already making money, my approach could help you refine your strategies and help you find more opportunities. Now, if you missed the first video, you should go check it out now. I told you about Ed Seykota. He's possibly the best trader you've never heard of. Ed's made a fortune trading markets from his home on the shore of Lake Tahoe. He's had a huge influence on my career, and influence I hope you'll be able to benefit from. I also told you about the 5 rules of trading, and these are: trade with the trend, have many relatively small trades, cut losses early, be slow to take profits, and give winners room to move. These are the steps some of the world's best traders use to make millions. It's a process I've followed for over 20 years, and it's given me an amazing amount of freedom. Take today, for instance. I've had time with my kids this morning, and now I'm here talking to you. It sure beats hanging out in the office all day. If you haven't seen video 1, go watch it right now. There's a link to it at the top of this page. Then come back for the second video. I'll still be here waiting for you. Okay, so in this video, I'm going to talk about rules 1 and 2, and that is trading with the trend and having many relatively small trades. Now, I'm not just going to tell you about it, I'm going to show you how to do it. And I'll be using examples from my own portfolio to help. What's more, you'll also see how one popular strategy could ruin your portfolio. You know, I was fortunate to learn about this early in my career, and it's been instrumental in helping me make millions of dollars from the markets. More importantly, it's also helped many of the people I've taught over the years to make better trading decisions. In a moment, I'm going to pick up where I left off. I'll continue explaining how you could use these trading rules right now, and I'm going to show you what not to do. And I think it'll surprise you. One of the most popular strategies, well, it's often one of the most dangerous. Now, we're going to cover a lot of ground today, so make sure you take some notes. You'll want to refer back to details of rule 1 and 2 later. Now, there's a reason you're watching this video. It's either you're starting out, or your current approach just isn't what it would be, or you're looking for a consistent and proven way to generate more opportunities. You also probably want all the freedoms that successful trading could give you, like the time freedom, location freedom, and the freedom of who you work with. And you know what? I can identify with all those things. When I was starting out, I didn't have a strategy. My trades were based on a combination of tips, news reports, and gut feel. But I was lucky. I was lucky to have some excellent mentors early on, and they made all the difference. They put me on the right path early in my career, and I haven't looked back. And that's what I love about this business. No one's born an expert trader. You don't need a fancy qualification or be employed by a Wall Street bank. All you need is a bit of capital and the right people to learn from. The people who've been there themselves, the people who've had the struggles and come out the other side. The alternative? Well, the alternative is a lot of trial and error. Or you do what many everyday traders I meet do. You hope things work out. You know, hope is a really interesting concept. If you're lost in the desert, hope can save your life. It's really important you have hope. Hope can keep you alive, and hope can stop you from giving up. But in the markets, hope's a dangerous word. You never want to hope. You never want to hope your trades do well. There isn't anyone coming to bail you out if things go wrong. You need a plan, a strategy. You need to put that strategy into place. I see traders relying on hope all the time. For example, someone invests heavily in a stock, they've done all the research, and they're confident it's the next big thing. They believe it could easily double or triple when other investors see what they see. But, you know, hope all they want, there's no certainties in the market. And I see this happen all the time. Rather than rise, the price falls, and then falls some more. Rather than selling, they keep hoping. But rather than hoping the shares will double, they now hope for recovery. They hope they can get out at break even. Traders who rely on hope often have short careers. They lose their capital and stop trading. Trust me, it's not the way to become a successful trader. Hope and trading rarely have a happy ending, and you don't want that. The cure for hope is a well-structured, well-engineered strategy. And the truth is, you wouldn't be watching this video if you didn't agree. If you weren't ready to step up and use a proven formula for trading the market. Whether you're just starting out or already trading, you're ready to raise your game and trade like some of the world's best. You owe it to yourself to be the best trader you can possibly be, and the process I'm going to teach you could be the solution you need. Now, I'd love you to join me as a member of my Motion Trader service, but no matter what, I know you're going to get a lot from this series. I really believe it could change the way you trade forever. Everything I'll be teaching you, I've learned from hard-won experience. Okay, let's get into the first rule. Now let's get into this with a question. Say your car's running smoothly, it's been getting around without a hint of trouble. Now what do you think will happen tomorrow? Will it keep working normally, or will you turn the key and nothing happens? Now, I'm betting you go with the first option. The odds favour your car works perfectly. Yes, something could go wrong tomorrow, but it probably won't. Our daily lives follow a similar pattern. If something works for us today, well, there's every chance it will continue to do so in the future. Take friendships, for instance. Why do you hang out with some people and not others? If you're like me, it's all to do with who you enjoy being around. These are the people you'll seek out and you'll hang out with for years to come. And this makes sense. As humans, we tend to continue doing things that reward us. It could be with relationships, a job, a holiday destination, or simply starting the car each morning. Simply put, if something works, then we generally keep doing it. But there's a notable exception to this, the stock market. You see, rather than buying a stock that's doing well and rising in price, many people do the opposite. They place orders for stocks that are falling. So why do they do this? Well, it's because they want to buy it below. Maybe you've done this yourself. You watch a stock fall until it appears to be selling at a big discount. Only then do you step in to buy. Now, this may feel like a safe strategy, but if you do this, you're trading against the trend. You're betting that something that isn't working today will work tomorrow. And the odds of success, well, they're stacked against you. So how do you flip the odds in your favour? Well, you do this by trading with the trend. That's how many of the best traders make money. Their secret is to buy as prices are rising, not falling. And this puts them on the right side of a stock's momentum, and it opens the potential for large share price gains. Let me prove it to you. I'm about to show you some results from backtesting. Now, backtesting is a powerful way to simulate how a strategy could perform in real time. Now, there are two big advantages to backtesting. Firstly, you can save years of trial and error, and secondly, you don't need to put thousands of dollars on the line. Now, backtesting is a process many of the best traders use. It shows them what they could expect from a strategy before placing a single live trade. So let's put two strategies to the test now. One that trades with the trend, and the other that trades against it. Now, there are many ways you can define a trend, and much of it depends on your time frame. For instance, some traders look for intraday trends, but this is time consuming and it really is a full-time job. Another option is to focus on longer-term price moves, and it's these longer-term moves that I'm interested in today. Now, for this comparison, I'll use the following basic definition. Stocks at a 52-week high are in an uptrend, and stocks at a 52-week low are at a downtrend. Now, the next step is to set the trading rules. To keep it simple, each strategy only has one key rule. Strategy 1 buys for stock is trending higher, that is, it's at a 1-year high. And strategy 2 buys for stock is trending lower, and that is, it's at a 1-year low. There's also a minimum entry price of 20 cents. This removes penny dreadfuls. These are the stocks that can double or halve overnight, and they often just increase the portfolio's volatility. But apart from that, the simulation includes practically every ASX stock. And finally, both strategies use a trailing stop. I'll tell you more about trailing stops later in the series, but basically it's a technique that allows profitable trades to run while cutting stocks that don't perform. Now, which strategy do you think will do best? Is it trading with the trend or trading against it? Okay, here's the results for trading with the trend. Check this out. This is a hypothetical profit of trading with the trend. It assumes putting $1,000 on every buy signal and there's no allowance for costs or dividends. Now remember, these are results from a very simple strategy. It's not a method I'd trade myself, but the message is clear. You can make a lot of money by trading with the trend. Okay, so let's turn this upside down. What if you trade against the trend? Instead of buying what's working, you look for stocks that are falling in price. Now, many people prefer to buy shares, they prefer to buy their shares this way. They'll target stocks that are trading near a 12-month low. The reason for doing this is that the worst is past and that better times lay ahead. But does this strategy really stack up? Do you think that bucking the trend is a better way to make money? Okay, here's what happens. Did you expect this? Trading against a trend, well, it's a disaster. The approach has little to show for itself after more than a decade. So why is this strategy an epic fail? Well, it's because you're betting against the odds. You're saying that something not working today will spring to life tomorrow. Sure, many falling stocks do eventually reverse course and head higher. And if you timed that turnaround correctly, you could do very well, but the odds favour that the prevailing trend will continue. You see, the trend is a path of least resistance. This often results in share price momentum persisting for longer than most people believe possible. And that's why many of the best traders buy into strength, not weakness. So how do you determine the trend? Well, a key driver for many professional trading systems is the moving average. Many of the best traders use this straightforward indicator to identify the trend. You know, if I was to use just one indicator, the moving average would be the one. Now, the calculation for a moving average, well, it's pretty easy to understand. It takes a stock's closing price for a set number of days and produces an average. The aim is to smooth the daily price changes, and this in turn helps to identify the trend. Let me show you what I mean. This is an actual trade from my own portfolio. The stock's name is Saracen Minerals. Now, have a look at the red and blue lines on the chart. These are the moving averages. The red line is a 50-day moving average and the blue line is a 100-day moving average. Here's how it works. When the 50-day moving average, and that's the red line, is above the 100-day moving average, the trend is up. This is the only time I'll consider placing a buy order. The opposite is true when the 50-day moving average drops below the 100-day moving average. This indicates that prices are in a downtrend. I'll avoid buying whenever this happens. Now let me switch the charts. Have a look at this. This time you'll see my entry and exit points. And remember, this is a real trade I place with my own money. Now, Saracen had been trading quietly for several months prior to my trade. The stock only came to my attention when the moving averages crossed and the price broke higher. With the odds now favouring a rising share price, my system triggered a buy signal. Now shift your focus to the right of the chart. Saracen hits my exit point for a 120% gain. By this time, the 50-day moving average is crossing below the 100-day moving average. This signals that the uptrend is over and that downward momentum is building. Saracen was no longer a potential buy. Now, there's a bit more to this trade than the moving averages. While they play a key role, they're only one part of a wider trading strategy. But that said, the moving average is a really important tool for identifying the trend. They provide a quick and consistent way to check a stock's momentum before you place a trade. You know, success in life often comes down to doing more of what's working and less of what's not. The same applies to trading. The odds favour a trend continuing. If a stock is doing well today, then it'll likely do well tomorrow. Trading with the trend gives you an edge over the many people who trade against it. So that's rule one. Always trade with the trend. It's a path of least resistance. If you can get this one concept right, I believe you'd be well on your way to trading profitably. Okay, so in the last section, I told you about rule one, and that is make sure you always trade with the trend. You see, the trend is a path of least resistance, and the odds favour that it continues. I also told you about one of my favourite indicators, the moving average. This can help ensure that you're on the right side of the big moves. A moving average is, well, it's the go-to indicator for many of the best traders. In this section, I'm going to tell you about a few words that had a huge impact on my career. In fact, I mightn't be talking to you today if I hadn't been given this advice. It's the key to ensuring your trading career doesn't come to a quick and abrupt end. I'm also going to show you how to apply this important lesson. You know, this could really change the way you build your portfolio, and it's not hard to do. Okay, so let's start with rule two. Inspirational, memorable, and concise. That's the formula for many of history's greatest quotes. Take these, for instance. All our dreams can come true if we have the courage to pursue them. Walt Disney. It doesn't matter how slowly you go, so long as you do not stop. Confucius. Success is walking from failure to failure with no loss of enthusiasm. Winston Churchill. Short statements like these are powerful. They reduce big concepts into a single sentence, and in doing so, their wisdom often stays with the reader for a lifetime. Chances are there's a quote that's made a difference to you. Sometimes it only takes a few select words to set you on the right path. I want to tell you about a quote that's had an impact on me. I describe this as a career shaper. I first heard it back in 1993, and it struck a chord with me ever since. Have a listen to this. If you don't bet, you can't win. If you lose all your chips, you can't bet. That quote comes from Larry Hyatt, a system trading pioneer. It's short, simple, and to the point. In a single line, it captures the essence of successful trading like few others. And if you can ingrain this one concept, you could be well on your way to trading profitably. Now, Larry's statement has two parts. First is the act of opening a trade. You can't win unless you put yourself in the game. Now, this may sound simple enough, but for many, it's not. You see, placing a live order means putting your money on the line. You're taking a risk that you'll lose, and this can be overwhelming. Fear affects regular traders and pros alike. Some of the best traders I know, they balk at pulling the trigger on a trade. You know, I sometimes hesitate to place an order myself. I'll discuss one of the tactics for overcoming fear a bit later. But now, listen to this. This is the second half of the quote again. If you lose all your chips, you can't bet. This is the single most important thing I can tell you. It's why many of the best traders, they focus more on what they could lose than what they could win. Yet for many people, it's the other way around. Look, some people even overlook risk completely. In a minute, I'll show you how to minimize the odds of losing all your chips. I was fortunate to learn this lesson early in my career. It's what separates the pros from the punters. But first, let me tell you about Larry Hyatt. Now, Larry is a pioneer of algorithmic trading. He was one of the first to use computers to test trading strategies. He also co-founded a highly successful trend-following hedge fund. Now, like many top traders, Larry's background isn't what you might expect. He wasn't an A-grade student, and he didn't start out as a graduate at a big investment bank. No, far from it. Larry began his career as an aspiring actor and screenwriter. From there, he got into the music business as a rock promoter, but his true passion was the markets. Larry jokes that he may be the only person to work as an actor to fund a trading career, and do you know what? He's probably right. Eventually, Larry made his way to Wall Street. He got a job with a stockbroker and began studying the markets full-time. Larry said that a key moment was when he realized trading was about the odds. He threw away his copies of the Principles of Securities Analysis and he bought a copy of Beat the Dealer. Another critical lesson was about risk. A wealthy friend told Larry that if he didn't bet his lifestyle, then nothing bad could happen. And this piece of advice stuck. Larry says his firm's number one rule is to keep risk small and consistent. So did this respect for risk pay off? You bet it did. Between 1981 and 1994, Larry's firm had annual returns over 30%. The firm was so successful it grew to be one of the largest funds of the type in the world. Larry keeps a low profile nowadays, but he remains one of the most successful traders of our time. So how important is Larry's number one rule? Well, many people make the mistake of placing a few big trades. They believe that's how the pros make money. If you want to win big, they say you got to bet big. Now sure, this approach may work when you're right, but look out when you're wrong. Just a single mistake could wipe you out. Larry takes the opposite approach. Rather than a few big bets, he risks relatively small sums across many trades. And he's not alone. Just about all the best traders do the same. You see, it's all about making sure they stay in the game. Controlling risk is critical. There's another advantage to this approach. The more trades you take, the better the odds of buying into some of the biggest trends. Let me show you what I mean. I have a series of 3 backtests for you. They all use my system's entry and exit triggers. The only difference is the percentage of capital they put into each trade. The backtests run for more than a decade. Each strategy starts with $50,000 and there's no allowance for cost or dividends. Here are the 3 scenarios. First up is an all or nothing strategy. This system bets 100% of capital on each trade. The second is typical of many smaller portfolios. Each trade receives 20% of capital. Finally, there's a many small bets approach. This strategy receives 5% of capital per trade, which allows for a portfolio of up to 20 stocks. Now, just pause for a moment. What do you think will happen? If you get this right, you'll start to see why so many people fail as traders. Okay, here's the first strategy. All or nothing is a volatile way to trade. Everything hinges on backing the right companies. You're just one bad call from disaster. Most of the stocks in this backtest underperform. Now, that's not to say this would always happen, but it did on this occasion. The system selects the first stock to signal an entry on the start date. You can make a lot of money with this method, but it only takes one mistake to bring it all crashing down. The strategy is like, look, it's a bit like playing the lottery. It requires loads of luck. Putting all your capital into one stock is it's a risk maximizing strategy. There's nowhere to hide when something goes wrong. Your portfolio takes a full hit. Now here's a 5-stock portfolio. Many traders like this type of approach. Again, a key reason for using this strategy is to score a big win. Some also say that a handful of stocks are easy to manage. But there's a problem. You see, you still have a lot riding on each trade. The downside of this is volatility. Have a close look at the graph. This approach can be unnerving. 5 stocks are certainly better than 1, but there's still a lot of risk. It only takes a handful of bad trades to ruin your returns. Okay, it's time for the final strategy. Here's a 20-stock portfolio. You can see the difference immediately. Volatility drops away while profitability increases. And remember, this is the same strategy as before. The only difference is trade size. There are no big positions, just a lot of relatively small ones. The small bets approach is, it's a natural risk limiter. It allows more trades, which in turn lowers the impact of any one stock. The result of this is better overall performance. Another benefit is that it can help diffuse fear. Remember what Larry's friend said, if you don't bet your lifestyle, then nothing bad can happen. Sure, you can still lose money, but if the individual stakes are relatively small, much of the fear evaporates. At the end of the day, it comes down to this. People who bet big are often chasing fast dollars. It may pay off some of the time, but risks have a habit of catching up with them. Sooner or later, they lose all the chips. So think about having a portfolio of relatively small trades. This helps spread your risk and it reduces exposure to any one stock. It's the best way I know to stay in the game. Okay, so we've covered a huge amount of ground in this video, so take a deep breath. I want you to have some time to absorb it all. To go over your notes, rewatch sections, I want rules 1 and 2 to really sink in. This video was about explaining 2 of the most important rules in trading. These are strategies that you can start applying really just about immediately. Now, I'd really like to hear from you. Where are you with your trading? Do you think either of these strategies could improve what you've been doing? Or do you think they could help you get started? Let me know in the comment section below. And if you found value in this video, then please share it with at least 3 people that you know, especially if they have any interest in trading for themselves. You know, it's always easy to get started on this journey when you have other people with you. I know from experience that this training will completely change the way many people trade. Now, I want to tell you about the video I have for you next. You're going to love this one, although it may sound a bit odd at first. You see, it's all about quitting. That's right, giving up and walking away. Now, this isn't something you'd usually associate with success, but when it comes to trading, it's the quitters who often make the most money. Yes, I know that sounds crazy, but trust me, it's true. And I'm going to back this up by showing you 3 trades from my own portfolio. And I can tell you, they're not the type of trades you're expecting. I'm also going to put you to the test. We're going to see how good you are at resisting temptation. And if you answer correctly, you could be perfectly suited for a strategy that makes a fortune for some of the world's best traders. So tune into the next video. I think you're really going to enjoy it. But right now, please scroll down and leave a comment for me. Tell me how these strategies are going to change the way you trade. And tell me, if we were to meet in 3 years, how do you think these strategies could have affected your results? So scroll down and leave me a comment, and I'll see you in the next video.